Markets turn their attention to Japanese affairs on Friday with inflation data heading up a session that also sees the BoJ with their latest monetary policy decision. No change expected in terms of headline interest rates, but with the fact that we're expected to see rates move towards the upside in the coming months and over the course of the next year, at the same time that we're seeing rates being cut pretty much across the board elsewhere in the world, are we going to see further downside in terms of dollar yen following a breakdown into a one-year low? And also, what does this mean in terms of Japanese stocks, to the Nikkei 225, alongside some of those big tech names in the US with the carry trade still on our mind? Right, so here's the breakdown in terms of market expectations according to Trading Economics. In terms of both core and headline inflation, both expected to move higher. Headline inflation up to 3%, core 2.8%, and core staying steady at 1.9%. But really, the volatility is likely to happen around that BoJ interest rate decision. Maybe not necessarily the decision itself, more so the outlining of where they see rates going in the future, with markets expecting to see them hike rates in the coming months, most notably in December. So let's get into some of the data. Here's a breakdown in terms of the inflation rate, the core inflation rate, and also wage growth. And the wage growth part is really key to this. Look, we've seen Japan struggle to lift inflation up to that 2% target for so many years now, that this big boom in inflation worldwide has provided the basis for them to be able to say, this is our opportunity to instill this new status quo that is inflation at 2%. It's something that we see around the world. People demand higher wages, and therefore, the price of goods goes up because the cost of inputs go up, and therefore people demand higher wages. It's circular inflation, and we don't necessarily see it so much in Japan. You hear stories about an item that was worth this one price 10 years ago is the same price now. And therefore, they want to try and kickstart the economy, because essentially, as long as you don't move anywhere and the rest of the world continues to see inflation, then around the world, your living standards essentially drop. Your ability to travel around the world drops. And so what we're looking at here is wages over and above inflation. That is a good thing. And it's the kind of thing that allows the central bank the opportunity to raise rates. And so as long as we see wages in this occasion, it's cash earnings well above and outstripping that headline CPI rate, it does provide the basis for us to think that we will see further rate hikes going forward. Notably, if you're looking at inflation, this Friday does see the nationwide number expected to tick it up to that 3% mark, I believe it was. And you can see here that essentially this would be replicating the upward momentum that we've seen in terms of the Tokyo metric. Bear in mind that Tokyo always leads nationwide. So if you're looking for the direction of travel for inflation in Japan, look for Tokyo first, because that will be the precursor to the directions, according to, as you see here, very close correlation for where the nationwide number moves. In terms of the breakdown for the for the headline inflation number out in Japan, we can see here 2.74. Notably, the figure that's going to be stripped out is this 0.19 figure from last August. And so we're going to be replacing that. The expectation is that, if you're looking at the figures that we're seeing recently, arguably out of the last 5 monthly metrics, only one of them has been below 0.19. And therefore, you can see why we're expecting to see inflation move towards the upside, because we've been seeing some decent chunky prints over recent months and in 2024 thus far. And you can see that because at the bottom, the 6-month annualized figure, which is the purple line, essentially points towards the fact that the last 6 months we are on track we're in a pace to set a 3.2% inflation rate. So if we're looking for the coming months, inflation, could move a little bit higher in this coming report. It's probably going to be flat the month after that. And then we can see a downside move when the October reading comes out because of that very strong single month metric. And then from then on in, you're probably likely to see inflation rise once again until we get to March, once March gets stripped out. So that's some way away from where we are at the moment. So inflation is going to remain above target for some time, it looks like. Certainly, I would say when that October reading comes out, that's that's the one time where we could see a pretty significant move towards the downside in terms of the CPI metric. In terms of the sort of levers that the BoJ will pull, one of them has been JGBs or government bonds. And so we're seeing them trying to roll off their bond purchases. And so they've been essentially trying to manipulate the market, trying to keep yields low. They're now taking the foot off the gas, really, in terms of these asset purchases. And so, you know, that could be negative for businesses, in particular, if we see borrowing costs rise. But crucially, we have actually seen private investors step in as we see the BoJ stepping off, essentially. And so that has actually kept a lid on bond yields thus far, which is a positive. And certainly also provides the basis for them to think that they can raise rates going forward, because they're not necessarily seeing spiraling bond yields that they're scared about doing more of the same with, essentially. Now I've got a number of different sort of relationships or breakdowns to go through, and I would say key amongst these is what's happening with the yen, because if we're looking in terms of movements for monetary policy, what hasn't been consistent is the reaction for markets, the stock markets, right? So 1 minute we're talking about a 50 basis point cut in the Federal Reserve and equities go higher. The next minute we talk about a 25 basis point cut and equities go higher because, well, it's not 50. And so 50 sometimes can be seen as a recessionary signal. Sometimes it can be seen as great. We're seeing plenty of easing. And so we've got a similar kind of thing here, right? You know, if we were to see the likes of the central bank taking action in terms of hiking rates or cutting rates, it's going to be impacting the Japanese yen, I believe, first. And there's an implication for stocks off the back of that. And that relationship is highlighted both in this chart and this chart. So first and foremost, the Nikkei 225 has a very close correlation between with dollar yen. Essentially, when we see the devaluation of the yen, it means that businesses can, number one, sell their goods abroad. So that means that their goods are internationally competitive because they're deemed very cheap, and they're more competitive compared to foreign sellers because the yen is devalued. Number two, their earnings that they earn abroad, once they bring them back in, you know, you're earning in a foreign currency. So as we see the devaluation of the yen, so that currency you're earning abroad, let's say US dollars, once it's brought back and put onto the balance sheet, it's larger. And so the flip side of that is that when we see dollar yen rolling over, we also see the likes of the Nikkei 225 rolling over. And that's exactly what we have been seeing. We've seen Japanese stocks under pressure of late. And therefore, if we see further downside in terms of dollar yen, I would expect us to see further downside in terms of Nikkei 225. This chart essentially highlights the relationship between the Nikkei 225 and the Dow Jones Industrial Average. Essentially, when we see dollar yen decline, we see the Nikkei declining also relative to the Dow. So it isn't only, it could be all stocks or all indices that are declining, but the Nikkei will decline more than the other ones because it has this effect coming into play around the value of the yen. We've also got the relationship between dollar yen and US tech stocks. And this has come to light recently, in particular, when we've seen the unwinding of the carry trade. You know, when you see multi-year rallies for a currency and you see borrowing costs pretty much at rock bottom over in Japan, well, people feel pretty confident to be able to essentially go over there, borrow a load of money, bring it back over into the US. The Japanese yen's devaluing anyway, so you're already winning on that side. You invest it in a bunch of tech stocks, you make your 10, 15, 20% a year. And, you know, it all makes sense because anything that you owe on your initial borrowing costs, that's going to be devalued away anyway by the dollar yen movement. And also you've made plenty of money on the other side of the bet. But we're seeing that all unwind. We're seeing that unwind because of the whole dollar yen side of things for one thing. And we're also seeing that unwind because as you see people start to reverse those positions and reverse the whole carry trade move, they're also selling some of these big tech stocks as a result. That means that, as you can see here, there's times where we have this positive correlation between the likes of the dollar yen and the Nasdaq. More recently, we've been seeing dollar yen continue to head lower, but we're not necessarily seeing that too much in the Nasdaq. And so that does highlight the idea that potentially much of that carry trade has been unwound, but we don't necessarily know whether it's fully unwound or what degree it is. And in which case, you know, if we were to see a sharp decline in terms of dollar yen, there is certainly a risk that we see further downside coming into play for the Nasdaq. Here's market expectations according to Icon for the BoJ. Where are we going to see the first rate hike? Well, December. That's going to be the next move. According to here, we've essentially got markets pricing a 69% chance that we see that hike of 10 basis points. And you look beyond that, where are we going to end up? Well, in a year's time, or just over a year's time, there's an expectation we'll be at 0.55. That means 3 10 basis point moves over the course of the next year, essentially, up until October of next year. So what we're looking for here is anything to change those views. So if we see them hiking this time around, if we see them say that they're very likely to hike next time around in October, and we shift it forward from December, all of those things would likely bolster the Japanese yen and drive dollar yen down once again, and the Nikkei 225 down once again, and potentially the Nasdaq also weakening off the back of that as well. The flip side is, of course, if they push it back and say they don't plan to hike rates this year and things like that, then you could see dollar yen moving towards the upside. The Nikkei 225 also following suit. In terms of the charts, let me just bring up a few of these charts so we can see exactly in real life exactly how this could play out. So here's a chart for dollar yen. First and foremost, the weekly time frame shows you the long-term trend, right? So since these lows that we have at the beginning of 2021, it's been a big uptrend where we've seen us move from essentially 104 all the way up to 160. So absolutely massive devaluation of the Japanese yen. Well, what have we seen recently? We've seen a drop down into the 140 mark, taking out that support level. You know, I would say taking it out, it's only a tentative move below that level, but nonetheless, we've broken into the lowest level in over a year now. And so it points towards a potential further downside or a continuation of this bearish trend. We're starting to pop a little bit back up above that 140. So there's a question mark on whether it's going to sort of catch people that have entered shorts below that level. So wouldn't necessarily be looking for a short right now, but as we regain ground, you know, if for me this intraday downtrend still remains intact, as you can see here, unless we see a break up through this 143 swing high, until that happens, near-term upside I think is likely to be sold into. The caveat here, of course, is whilst we're looking for the BoJ to be laying the groundwork for interest rate hikes going forward, we've got the question marks over in the US about how many rate cuts we're going to be seeing, and markets have grown a little bit excited, I would say. And if you look on the CME FedWatch site, they're pointing towards a 63% chance, at the last time I glanced at it today, that we see either 125 or 150 basis points worth of cuts over the course of this year. That means in 3 meetings, there is a base case scenario that we see at least 2 of those meetings have a 50 basis point cut. That seems a lot to me, to be honest. I don't necessarily think that the Federal Reserve is going to do that, because they might think that it portrays them in a certain light, and that they're feeling a certain way in terms of the risks evident within the economy at the moment. And they think that it might spook the markets. I think that's the case, but who knows? You know, maybe there's people that know more than me behind the scenes, and they're the people that are really affecting these markets. But certainly, I think it's going to be unlikely. And certainly, you know, I think also the 50 basis point move on the first FOMC meeting, you've also got to consider the implications from a political standpoint. If Trump comes in and he's just been preceded by a 50 basis point cut, he's probably going to be looking for someone else to take the helm at the Federal Reserve. So if we see a repricing away from so many rate cuts from the Federal Reserve, you could also see that help lift dollar yen for the near term, at least, anyway, and that could sort of feed into a retracement move. But nonetheless, if we're talking about that, we're talking about the Nikkei 225. So as we see weakness in terms of the Japanese yen, or sorry, in terms of dollar yen, so that would likely feed into the Japanese stock market. at the moment, we've been seeing, we saw this tight move, and then we've seen a disparity where stocks have rebounded to a much greater extent than the Nikkei 225. In part, I've certainly read that people are saying, well, for all of this talk of businesses being uncompetitive once the Japanese yen starts to strengthen, that isn't the case. They continue to be strong. They continue to have very strong earnings. Maybe that is the case, and maybe the size of the move for the stock market is somewhat overblown, and that you should, for every, sharp decline we see in dollar yen, we see a moderate decline in terms of stocks. Maybe that's the case, but certainly if we do see a continuation of this downside move for dollar yen, I think it's a good chance that we see weakness in terms of Nikkei 225, and at least an underperformance compared to US markets, as we saw previously with that ratio between the Nikkei 225 and the Dow Jones Industrial Average. And that takes us on to the final one of the lot, which is the carry trade. Of course, we have the question marks around this carry trade where people are borrowing in Japan, putting it onto big tech stocks and earning plenty of money in the past, but it's all coming crashing down with the reversal that we're seeing in terms of dollar yen. So how much of it has been unwound? Is there more in the tank? Well, the further we go down in terms of dollar yen, you would think the more it unwinds. And so with the fact that we're seeing this weakness in terms of dollar yen, well, the Nasdaq having rallied back up into trendline resistance and this 76.4 Fibonacci resistance, I think there's a good chance that we see some weakness coming into play. This isn't just a dollar yen carry trade thing. It's also the fact that we're entering into a period where we see earnings come back into place soon enough. So next month is the beginning of new earnings season, and at the beginning of each earnings season, it seems like equities in the tech stock area seem to be sold as people become fearful that they're not going to be able to justify their sky high valuations. So you have that. You also have the precursor to the election taking place in early November. And of course, you have the fact that September is historically the worst month of the year for stocks. And don't forget, September's not a good month. October generally is, unless it's pre-US election. So that would point towards the potential for some volatility at least. And we're coming off the back of a strong move higher in terms of the Nasdaq over the course of the past week. I wouldn't be surprised to see some selling pressure coming into play before long. I don't expect us to just rally out of here and push up into new highs over the very near future. I think there's going to be a few more tricks up our sleeve and a bit more volatility for us to contend with. I hope this has been useful. We've got plenty of videos out at the moment. Markets are really interesting at the moment, quite frankly, and we'll keep them coming for you. Make sure to subscribe and like the videos. Comment if there's other things you want me to be talking about and covering as well. I'm open-minded to these things. Have a great day. Good luck with your trading. And yeah, until next time, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot.